Is a wild crisis looming? That is the question nobody on television wants to ask directly. That is the question politicians dance around. That is the question Wall Street pretends not to hear. But there is one man who does not speak loudly, does not panic publicly, and does not make dramatic predictions. He simply moves. And when Warren Buffett moves, the smart money watches. Because Buffett does not prepare for headlines. He prepares for storms. And lately, his moves have been anything but random. He has been unusually calm, almost too calm. While markets swing wildly, while commentators shout about soft landings and resilient economies, Buffett has been quietly repositioning billions of dollars, not millions. So today we are going to decode 6 major moves, 6 strategic decisions, 6 signals that might be telling us something big. Because if a wild crisis is looming, Buffett is not waiting for it. He is preparing for it. Let's start with something that shocked even seasoned investors. Snowflake, a fast-growing cloud data company, a technology IPO. Now pause for a second. Warren Buffett does not buy IPOs. He avoids them. He has said many times that he prefers businesses with long track records. He likes predictability. He likes simplicity. The last time he invested in a fresh public offering before this era was decades ago. We are talking 1950s. So why would he suddenly jump into a hot tech IPO and not just dip a toe? He invested hundreds of millions of dollars. Snowflake specializes in cloud data storage and analytics. In simple terms, it helps companies store and manage massive amounts of information in the cloud. Why is that important? Because remote work exploded. Digital infrastructure became critical. Companies moved operations online at record speed, and that shift is not reversing. Buffett's investment suggests something powerful. He believes digital infrastructure is no longer optional. It is essential. He may also believe that disruptions like pandemics, geopolitical tensions, or economic shocks will continue forcing companies to operate remotely and digitally. This is not a short-term trade. This is positioning for a structural shift. But here is the deeper layer. When Buffett breaks one of his own rules, it matters. It signals adaptation. It signals that the world has changed enough that even the most traditional value investor must evolve. And when a legend adapts, you should ask why. Is it because the next crisis will not look like the last one? Is it because resilience now depends on data and cloud infrastructure? Now, let's pivot. Because while he was buying tech, he was also selling something else aggressively. For decades, banks were a cornerstone of Buffett's portfolio. He loved them. He understood them. He invested heavily in them. But recently, he cut major positions. He reduced stakes in JP Morgan. He exited Goldman Sachs. He trimmed Wells Fargo, a longtime favorite. Let's think logically. Banks thrive when interest rates are healthy and predictable. They make money on the spread between what they pay depositors and what they charge borrowers. But in an environment of ultra-low rates or erratic rate policy, margins compress, profitability gets squeezed, and that is just the beginning. In times of economic stress, loan defaults rise, unemployment rises, businesses struggle, credit card delinquencies increase, mortgages go unpaid. That hits banks directly. Now, imagine a prolonged slowdown. Imagine a credit crisis triggered by over-leveraged sectors. Buffett may not be predicting disaster, but he clearly sees elevated risk. He is reducing exposure before the pain becomes obvious. And here is something even more interesting. He did increase his position in one bank, Bank of America. Not all banks are equal. Some are stronger, better capitalized, more conservatively managed. Buffett is not running from the entire sector. He is becoming selective. Extremely selective. That is not panic. That is surgical risk management. Now let's talk about something that rarely gets mainstream attention. Share buybacks. Buffett authorized massive repurchases of Berkshire Hathaway stock, Billions of dollars. Why does that matter? Because buybacks tell you two things. First, Buffett believes his own company is undervalued. Second, he may not see many attractive opportunities elsewhere. Think about that. If one of the greatest capital allocators in history struggles to find compelling deals, what does that say about overall market valuations? It suggests caution. Buybacks reduce the number of shares outstanding. That increases each remaining shareholder's ownership percentage. It is like slicing the same pie into fewer pieces. Each piece becomes larger. And unlike dividends, buybacks can be more tax efficient. So this move rewards shareholders. But it also whispers something else. Cash is abundant. Opportunities are scarce, or at least scarce at the right price. Buffett has always said he prefers to be greedy when others are fearful and fearful when others are greedy. Perhaps he senses too much optimism. Perhaps he believes patience will soon be rewarded. Now let's cross the Pacific. Buffett invested billions into 5 major Japanese trading conglomerates. Mitsubishi. These are not flashy tech startups. These are massive, diversified trading houses. They operate across energy, metals, food, chemicals, logistics, and industrial sectors. They are deeply connected to global commodity flows. And that word matters. Commodities. These companies are tied to real assets, hard assets, agriculture, infrastructure. When inflation rises, hard assets often hold value better than financial assets. After the 2008 crisis, commodities experienced powerful rallies. Buffett may be positioning for something similar. He may be preparing for a world where inflation lingers, where supply chains remain fragile, where geopolitical tensions disrupt trade. These Japanese conglomerates also resemble Berkshire's own model: diversified, cash-generating, resilient. He understands them. He respects them. And importantly, they were attractively priced. Buffett does not chase hype. He buys value, even if it is overseas. Now, let's talk about energy, specifically natural gas infrastructure. Buffett acquired significant energy assets from Dominion Energy: pipelines, transmission networks, liquefied natural gas facilities. Why is this significant? Because energy infrastructure is not glamorous, but it is essential. It produces steady cash flow. It operates like a toll road. Gas flows, fees are collected, revenue is predictable. In uncertain times, predictability becomes priceless. Energy demand does not disappear during recessions. It may slow, but society still needs power, electricity, transportation. And by increasing control over gas transmission, Buffett strengthened Berkshire's position in a critical sector. Energy is the backbone of economic activity. If you believe turbulence is coming, owning the backbone is not a bad idea. And now we arrive at perhaps the most symbolic move. For years, Buffett criticized gold. He famously said gold just sits there. It does not produce earnings. It does not innovate. It does not generate cash flow. Yet, he invested in a major gold mining company. Not the metal directly, but the business of extracting it. Because gold often acts as a hedge against inflation and currency debasement. When central banks print aggressively, when debt balloons, when confidence in fiat currencies wavers, gold tends to shine. Investing in a gold miner is slightly different than hoarding bullion. A miner produces cash flow. It benefits from rising gold prices. It still fits into Buffett's preference for productive assets. But the message is hard to ignore. He is not betting everything on gold. He is allocating strategically. It is a hedge, a subtle preparation. So let's step back. What did these 6 moves collectively tell us? First, digital infrastructure is critical. Second, banks face structural and cyclical risks. Third, valuations in broader markets may be stretched. Fourth, global diversification into hard assets matters. Fifth, energy infrastructure remains foundational. Sixth, Inflation protection is prudent. Now let's go deeper. Buffett is not a doomsday prophet. He does not bet on collapse. He bets on resilience. Every move strengthens durability. Cloud data for a digital world. Selective banking exposure. Buybacks when value exists. Commodities through Japanese conglomerates. Energy pipelines. Gold mining. This is not panic positioning. This is fortress positioning. It is building a portfolio that can survive multiple scenarios: high inflation, low growth, market volatility, geopolitical conflict, supply shocks, credit tightening. He is not guessing one outcome. He is preparing for several, and that might be the most important lesson, because many investors try to predict the exact future. Buffett prepares for uncertainty itself. Let me ask you something. If everything were perfectly stable, perfectly predictable, and smoothly growing, would these moves look different? He might lean heavier into growth. He might deploy more aggressive capital. Instead, we see caution, selectivity, cash discipline, and patience. Lots of patience. There is another layer most people overlook: psychology. Markets are emotional machines. When optimism dominates, risk gets underpriced. When fear dominates, opportunity explodes. Buffett watches sentiment carefully. If he senses complacency, he becomes conservative. If he senses panic, he becomes aggressive. So ask yourself honestly, what dominates today? Complacency or fear? Are investors pricing in perfect outcomes? Or are they bracing for turbulence? Because Buffett's behavior suggests he sees enough uncertainty to tread carefully. Here is something else. Buffett always keeps massive cash reserves. People criticize him for it. They say he misses rallies. They say he underperforms in bull markets, but cash is optionality. Cash is flexibility. Cash is the ability to strike when assets go on sale. In 2008, he deployed capital when others were paralyzed. He secured favorable deals with companies desperate for liquidity. He acted when fear peaked. Perhaps he is waiting again, not wishing for crisis, but prepared if it arrives. And that is the key difference between panic and preparation. Panic reacts. Preparation anticipates. So is a wild crisis looming? No one can say with certainty, but cycles are real. Boom and bust are part of economic history. Debt builds, excess forms, corrections cleanse, then recovery begins. The pattern repeats. Buffett has lived through oil shocks, inflation spikes, crashes, bubbles, recessions, and financial meltdowns. He does not assume stability is permanent. He assumes change is constant, and that mindset might be his greatest edge. Here is the uncomfortable truth. Most retail investors chase performance. They buy after rallies. They sell after drops. They react emotionally. Buffett does the opposite. He sells when risk rises quietly. He buys when value appears quietly. He does not announce alarms. He adjusts exposure. That is what we are seeing now. Subtle shifts, strategic reallocations, risk trimming, hard asset accumulation, digital infrastructure investment, energy expansion, inflation hedging. It is not flashy. It is methodical. It is disciplined. And discipline wins over time. Now, imagine a scenario. Inflation persists longer than expected. Interest rates stay elevated or volatile. Credit tightens. Consumers slow spending. Corporate earnings compress. Markets correct sharply. Which portfolio survives better? One overloaded with speculative growth, or one balanced with energy, commodities, infrastructure, cash flow, and selective tech? Buffett seems to favor the latter. He is not abandoning growth entirely. He is integrating resilience. That distinction matters because survival is step one. Opportunity comes to those who survive. If a wild crisis hits, capital preservation becomes king, liquidity becomes power, hard assets become shields, and patient investors become hunters. Buffett has always hunted during chaos, but only because he prepared before it. That is the message, hiding in plain sight. Preparation is invisible until it becomes obvious. By the time headlines scream crisis, it is often too late to reposition gracefully. So what can you take from this? You do not need billions. You do not need insider access. But you can adopt principles, diversify intelligently, respect valuation, understand macro risks, balance growth with durability, avoid emotional extremes, keep some liquidity, think long-term, and above all, stop chasing noise. Buffett rarely comments on short-term drama. He studies fundamentals. He analyzes cash flows. He evaluates management quality. He thinks in decades. That time horizon changes everything. Because short-term volatility looks terrifying up close. But zoom out. History rewards disciplined ownership of productive assets, even through crises, especially through crises. So maybe the real question is not whether a wild crisis is looming. Maybe the real question is this. If it comes, will you be prepared? Will your portfolio bend or break? Will you react emotionally or strategically? Will you freeze or act? Buffett is showing us his answer. Quiet moves, calculated shifts, strategic hedges, selective aggression, disciplined patience. He is not shouting warnings. He is positioning. And sometimes, positioning speaks louder than prediction. Watch actions, not words. Follow capital flows, not headlines. Study allocation, not speculation. Because in the end, wealth is not built by guessing the next headline. It is built by preparing for multiple futures. Buffett knows that. And if a wild crisis is looming, he will not be surprised. He will be ready. The only question left is whether you will be too.